Ladies and gentlemen, please welcome your panel on Portfolio Risks. What are you ignoring? Moderated by Chief Investment Officer of the Dallas Employees Retirement Fund, Cheryl Alston.
Well, good afternoon, everyone. I said, welcome to the discussion on portfolio risks. What are you ignoring? I said, my name is Cheryl Alston, and I am the Executive Director and Chief Investment Officer of the Dallas Employees Retirement Fund, and I will serve as the moderator. And we are so pleased to welcome 4 experts in their field. We'll start with Chris Ailman, who is the Chief Investment Officer of the California State Teachers Retirement System, and he also serves as co-chair of the Global Capital Markets Advisory Council for the Milken Institute. Robert Gibbins, the Chief Investment Officer for Autonomy Capital. Tim Romer, CEO of Fundamental Infrastructure's Opportunity. And Andrew Steele, Global Head of Sustainable Finance for Fitch Ratings. So, as you know, most investors have their own metrics to assess an asset's risk, or they use firms such as rating agencies to support their research. But what might be some of the hidden risks that you have not assessed or priced? And so we're going to delve into some of the hidden risks. Environmental risks are increasing in prominence and impact. According to the World Economic Forum's Global Risk Report in 2018, 3 of the top 5 risks that are most likely to occur in the next 10 years are environmental in nature. Extreme weather events ranked first, natural disasters second, and a failure of climate change mitigation and adaptation came in 5th. So Robert, as the Chief Investment Officer of a macro fund, can you talk a little bit about some of the trends you see in the data and how you incorporate those trends into your investment process?
Thank you. So as investors and fiduciaries, I think there's really 2 things that we're looking at. There's the cost of climate change, and then there's the price of carbon. And when we look at the UN IPCC report, basically it says, through radical action, we can keep the temperatures to 1.5 degrees by 2100. But when we check into the science of the report, when we talk to the scientists who actually wrote the report, what they're saying is they're thinking 2.5 degrees centigrade to 7 degrees is where their confidence interval is for 2100. And when you look into that report and you see what the radical action would be that would get to 1.5 degrees, it's actually negative emissions. So negative emissions is important. As you know, Paris, we signed up to a whole host of national agreements. Those agreements would keep us to about 3.4 degrees centigrade. So that's not where we want to be. And since Paris, emissions have subsequently accelerated. So we're at record high emissions now. So when we get into negative emissions, what does that really mean for us as portfolio managers? What does it mean for us as investors? Well, what it means is, in order to have negative emissions, in order to deploy, to develop, to construct, to have the technologies that actually suck carbon out of the atmosphere, which is what's in this report, effectively to get to that headline figure, you have to have a specific price of carbon. A specific price of carbon. What's that specific price of carbon? It's the clearing price of carbon. It's the price of marginal abatement at industrial scale. So when we think about what this means, it means that when we think about stranded assets, of course, we're all familiar with coal and oil and things like this, but we have to think through, if we're going to be thinking about a specific and explicit price of carbon according to our technological solutions, we have to stress test our assets throughout our portfolio to understand how they stack up to such a development. I think that's super crucial. So it's not just going to be stranded coal assets. There's going to be transitions required. There's going to be changes required. There's going to be vulnerabilities and problems in certain cases throughout all the assets or some of the assets that we invest. Then the second point is the cost. What is the cost of climate change? And here, what we can see is that since 2000, it's pretty clear that the natural systems have gone nonlinear in pace of change, and they can go nonlinear again. and that is manifesting itself into costs that we see today in our portfolio. And whether it's the discussion that came out today about moving the capital of Indonesia, Jakarta, to higher land, whether it's the floods or the droughts that we've seen, whether it's the inflation shocks that we've seen, these have all been issues. I think that you should all be very, very clear on what you think about the price of carbon, but to the extent that we transition here slowly, then the cost of climate change is going to be increasingly an issue. And here, what I'd say is we have to think about some of the assumptions we make around various collateral. For example, when you look at the steady provision of insurance at a reasonable rate that we all ultimately rely on for the persistence of value in certain collateral markets, such as coastal real estate in the east coast of the US, or whether it be fire insurance in California, all of these things are important because the nonlinearity of the climate system is showing up in the data and some of the issues that we're seeing, and it will ultimately show up in the insurance market, and that will be clearly an issue for collateral values.
Absolutely. Andrew, on the regulatory front, the number of climate laws that has passed globally has doubled every 5 years since 1997. What do you see as some of the costs and opportunities as the world seeks to adopt clean energy and other climate-related risks? And is the burden of climate change falling to the industries, or so the citizens do not feel the impact?
Sure. I mean, I think maybe before I start answering that, we'll just reverse up slightly. And what I would say is that it is very important when you're thinking about these issues to not confuse fixed income credit with equity. And you do need to think about the two separately. And a lot of people, when they talk about these, they talk about it as if it's one big thing. But actually, if you're thinking about portfolios and you're thinking about how you examine your portfolios, then we've started integrating and separating out ESG risks on all the entities that we rate. And what that is telling us is that on the fixed income credit side, governance and social risks are far more important for credit ratings than environment is. And that's because environment is easier to see and measure in the credit impact timeframes that we're looking at. And that's the difference between fixed income and equities. You've got very different timeframes coming into play. And so that's very important. When you look at the change in regulation, you look at the change in laws that have gone on over the years, it definitely helps, but what it does is it kind of frames the issue, and it doesn't really tackle the issue. It provides a framework in which to look at these issues and to examine them. And it's interesting to hear the wide range of 2100 certainty over the degree changes, because certainly the trajectory that we're on at the moment is somewhere around about 4.5–5%. And actually for a lot of developed market countries where they made gains initially by essentially outsourcing their carbon emissions to other countries, it's becoming increasingly a lot harder. You see that in places like Germany in Europe. And so I think in terms of challenges, then when you look at the bigger picture and you look at this longer term framework, the thing that a lot of people tend to ignore is that we have suffered essentially from hydrocarbon addiction for nearly 100 years. And what we're saying is we need to wean ourselves off that addiction in a very short period of time. And that's not easy. If you look at the way that the frameworks are set up, if you look where government revenues come from in terms of taxation on oil, taxation on all sorts of different manufacturing processes that actually rely on hydrocarbons, there's not a huge political incentive to do anything about this quickly. Because what you do is you increase costs for your population and you reduce tax revenues at the same time. If you're a politician, that gets you fired. So it's a one-term event. And what you see is you see a lot of talk about doing stuff. You see regulatory changes, but it doesn't really bite. And kind of everybody is waiting, I think, to see whether it makes a difference. But personally, my own view on how you actually get somewhere on this is it requires a mindset change and it requires sacrifices. There is a huge difference, and I know we'll come on to talk about this, between emerging markets and developed markets. I mean, developed markets here, we talk about reducing carbon emissions, but the population in the US is perhaps a quarter of that in China, and China is growing fast, and people have aspirations. They've got materiality that they want to address. But from an investment perspective, then I guess the challenges are what's the speed, and I think that's already been addressed by my fellow panelist. In terms of the opportunities, then price differentiation should start to come through as people really focus on these issues. And ultimately, the real cost of activities should start to get reflected. Whether that happens quickly or over a longer period of time, I think you're right, over a longer period of time, Robert, that it becomes much more expensive. But short-term pain is always very difficult for people to put up with. And so I tend to be a little bit more relaxed about the stranded assets perspective. I think you'll find shifts, and I think you'll find shifts in pricing where the real true cost of things will start to get priced into the equation. I think green bonds are a little bit of a distraction. I think green bonds will probably die out, and ESG will just be part of investing. If you don't do it, it will cost you more because you will have less liquidity, you will have fewer investors interested in investing in the type of bonds you issue.
Tim, as countries are really seeking to make progress on the sustainability agenda, what are some of the hidden risks that governments are exposed to, and how can they address those risks? And are organizations like FEMA, are they creating safety nets for other unwise investments?
I think it's interesting, and I think the panel's interesting because I come at things from a micro perspective. We focus on credit in the U.S., in infrastructure, generally with a government attachment. And so I look at the world, too, from a credit perspective, but a very localized perspective. It's a developed country, but the risks here in the U.S. are hidden. I think there's opportunity, too, I'll talk about. But you can look out there and you can look at the weather events, whether it's the hurricanes in Florida or Texas. Puerto Rico is a great example of an entity that, from a credit perspective, had severe hidden risks that no one really anticipated. And now, we're all kind of, thinking about how to pay for it. Subtle hidden risks. I don't know if you guys think about this, but San Francisco, the sewer system is a gravity-fed sewer system. There are studies that show when the sea level rises, it no longer gravity feeds. So how do you dispose of all the sewer within the city of San Francisco? Interesting hidden risks that it's not disclosed, it's not talked about. So it's out there. And I think you can't think about this as government risk alone because the government provides the infrastructure that makes the local economy work. So these risks quickly spill over to the private sector. And so the private sector has to be much more thoughtful and conversant as to what those risks are. So as an investor, I think a lot about it. And so when we look at it, we think they're risks, but there's opportunity. And I think it's important to split ESG up. I think it's almost getting too conflated in too many different ways, and it's being too broad-based. And so what we spend a lot of time thinking about is the E side of that. What are those environmental risks? A little spill over to the social side. I don't worry about governance much because I'm in the US, it's a different marketplace. But when you think about it that way, it's a little different equation and a little different problem that you have to think about. And I think the real challenge is how do you link better the cost or the externalities and the benefits? And I think this is where the whole carbon debate hasn't found solid footing yet, but it very much gets into the issue that FEMA creates, right? I think a lot of governments view FEMA as the insurer of last resort. I mean, they're sort of a put to FEMA to sort of solve my problem. Now, FEMA has slowly become more, I think, aggressive about what they're insuring and what they won't. But why shouldn't FEMA charge? Why shouldn't FEMA be like an insurance company and assess those risks and charge people for them to change behavior? So you can think about how do we think differently about these risks? Who's benefiting from them and who should pay for them? On the opportunity side, I think it's fascinating because I think in the US, we have huge infrastructure needs going forward. The numbers are multi-trillion dollars over the next 10 years. And so there really is a good chance to change how we think about infrastructure, how to make it more sustainable, how to make it more resilient to sort of mitigate those risks going forward. And I think there's real opportunity there. I agree, green bonds are nice, but it's sort of binary. It's green or it's not. I think there needs to be a much more robust system by which you scale, measure, and evaluate the E side of the equation at a minimum. And you need honest brokers out there saying, look, that issuer, that bond, how green is it? Is it a 1 or is it a 10? I need to know both. And I think the last point I make is I think we need to flip this around. Everyone that says, well, we're going to issue green bonds because someone will pay more. The yield on the green bond will be lower. None of us want to do that. We're investors, right? We want the highest return possible. I think what's going to happen is what you alluded to, Andrew, is I think the bad actors are actually going to start paying more. So the cost of capital to those that aren't performing, aren't focused on ESG, their access and cost of capital is going to go up. And I think we need to shift the equation a little bit more to think about, what is who are the good actors, who are the bad actors, and get that information out to the marketplace.
Yeah, great. So Chris, more and more investors are looking to integrate sustainability related insights and data into their traditional investment processes. So what does it mean for investors? How do you factor the cost of kind of rising seas, the sewer system in San Francisco, and other climate events into your portfolio?
Cheryl, that's part of the challenge, is I think you made the comment that it's nonlinear. And so we have the difficulty, we're not climatologists, we've got the challenge of trying to figure out when is this going to occur. We know it's a risk. So the secret to our panel of what risk are you not paying attention to? I don't think the markets are pricing in the risk of climate change because we're too short-term oriented. We just don't pay attention. I often say to people, we pay a fee to dispose of our wastewater. We pay a fee to even dispose of our physical waste, which is garbage, but we don't pay any fee to dispose of our gaseous waste. That's why you need a price on carbon, is that you need the mechanism to kick in. And our risk systems are really good at pricing counterparty risk and financial risk, and somehow it drives me nuts that ESG is considered non-financial. And my point is, that's all based on your time horizon. Right. My CFO's here, so I got to be careful what I say, but financial reports are almost all backwards looking, either one point in time or for 1 year period behind you. ESG risks are what's in front of you. And sometimes they're very long term. So we're talking about 2100. That's kind of tough to visualize in my investment period. But we know the climate is changing. We know it's more variable. And I think you're starting to see people like the CFA Institute start to include that in their curriculum. I've been part of the Sustainability Accounting Standards Board, SASB, really trying to push companies to report on material ESG risks in their industry. And now we have the TCFD. I know it's an alphabet soup, but TCFD is the Task Force for Financial Climate Disclosure, and trying to get out there to say to people, you better start thinking about 1.5 degrees. You better start thinking about 2 degrees and disclose to us as investors so that we can factor it into our risk model. Because right now it's not there. It's really about pushing the envelope and thinking longer term. You brought up some great anecdotal issues. I'm still stuck on the picture of San Francisco and what that means when the tides shift. But I've often said to people, part of the challenge for us is just like Cheryl, like you, we tend to be a passive investor. We own the entire market. We assume the market is going to price in these externalities. So part of my question back to you both said, the market will reflect these. Well, when? At the last moment, after the crisis? At some point, it's got to start reflecting that companies are being resilient or not being resilient. And unless I have a better scale and a better grading system, I don't know how I'm going to be able to figure that out. And if I don't want to be passive, then I have to be active. And I've often used sea rise as a classic example. Let's say we all in this room could agree the sea is going to rise, but there's still 2 bits of information I need to know. By how much? Is it going to be 3 centimeters or 3 meters? And is it going to be in the next 20 years or the next 120 years? And those 2 things would really change your opinion about, say, owning real estate in Miami, not to mention outside around the rest of the world. So for us, we need to factor in, but I don't know how we do it.
I think, Chris, that's what I was getting at too, is that having that really honest, verifiable data. We're in a world of big data. We're in a world of artificial intelligence. I don't know why we can't use that. I mean, the science around the environment is pretty well proven. People seem to be questioning it, but I trust scientists. There's a lot of smart scientists out there. To me, it's like, how do we, and like relying on folks like you, come up with a real measure we can look and trust? And that's why I agree. Green bonds aren't it, because it's just yes or no. But I think having those metrics and letting that information to the market and let the market value and price it would be helpful.
Well, and that's why I want companies to start disclosing is tell us at least what you're thinking about. We know you're not going to have a hard answer, but that disclosure, then I can hire services that can rate and tell me who's resilient and planning ahead and who's burying their head in the sand.
And perhaps that takes us back to your original question about how does that actually happen, and your reference to regulation and laws.
Yes.
And I think ultimately, you know, you were saying, well, when will this actually happen? And I think the answer is if you leave it to the markets, you know, we've had this addiction for over 100 years. It's going to take 50 to 75 years for the markets to gradually wean themselves off that. And that clearly doesn't work with any of the timeframes that people are wanting to actually try and execute. And so I think regulation will play a big part going forwards. And I suspect it will come more from non-developed countries. If you look at what China is doing, then China, the securities regulator there, plus the Department of Environment for the Chinese government, they've introduced legislation that from 2020, every listed entity within the Chinese domestic network will have to disclose ESG metrics. And anybody issuing a bond domestically will also have to disclose ESG. And there's a standardized form for that. So in a sense, they are moving faster and further ahead than the developed markets. But they need to. And one of the problems you have is it's very easy for us in the developed market, where we've benefited hugely from internationalization, from globalization, from outsourcing our carbon production into other places and getting cheap goods in return, to then say, well, actually, you emerging economies which are thriving and developing very fast with extremely large populations, you shouldn't aspire to this. You should aspire to something different. And actually, that's really difficult. But I think that there is some very positive change going on there. I mean, I think China will definitely lead the way. There's kind of a benefit to being a centrally controlled socialist government with capitalism embedded in the private sector there, which is kind of a very strange combination. But
sorry, if I could just say a few things. You know, when we talk to the scientists about where they are with sea level, I mean, right now we're 3 millimeters per annum, but when we talk to some of the best people, the people who wrote the UN IPCC report, they tell us, look, by 2060, 2070, I can't tell you whether it's 3 millimeters or 5.5 centimeters per annum. That's the confidence interval we have. And that's what I really mean about nonlinearity. And so where I'm at here is that because something happens, it's not like everything's okay and then, and nobody's suggesting that everything's okay and then 2100 it all falls to pieces. This is a process which is increasingly evident. We're all here talking about it. We're all very, very, very aware. And my issue with market risk is that what we're really talking about is the market's capacity to understand the present value function of a risk that it sees brought up in terms of its time horizon. I think that the one thing that I really want to emphasize is, you know, we're seeing nonlinear natural systems reactions really in the last 10 years. We're not going back to the climate we had as children. And we don't yet know where exactly we're going to go. And as this becomes very clear, this has got all the mechanisms, all the makings of a climate, you know, of a panic where we present value. When we think about social security issues, for example, we had the huge crisis in Brazil, market panicked. What was the issue about? Well, it was about whether people retire at age 68 or 65 or 63. It's hardly a day-to-day issue, but the market has the capacity to see that non sequitur, see that issue in the future, and demand through price action a framework to deal with it today. And that's, I think, what concerns me. I see a huge issue here.
Excellent. So let's stay on a topic. Let's shift to our discussion of infrastructure. Andrew, you mentioned a little bit about China, and 6 of the world's 7 largest economies in 2050 will be current emerging economies. 3 of the top 4 will be located in Asia, according to PwC. And this is already fueling the infrastructure needs of those societies, as evidenced by the Chinese government's One Belt, One Road initiative, fast rail links, and upgraded port facilities are all signs of this change. So Andrea, I know you have served in various capacities, including as an independent expert for the UN Economic Council. Please talk about the key issues and risks in emerging countries for infrastructure.
Sure. I mean, one of the key opportunities, and it's also a risk in terms of a global risk, is the fact that infrastructure remains fairly undeveloped relative to developed markets. And therefore, there's a lot of opportunity for investment in that. But then there is also a lot of risk that you look at the energy infrastructure in China, for instance. By 2050, coal-fired production in China will still be over 60% of the generation pool. And that's a lot compared to anywhere else in the world. And it's also on a trajectory that is gradually growing as well. And so that's a very big risk from a climate change perspective. The opportunity to invest in clean coal, maybe to change the way in which things happen, is clearly there. I mean, infrastructure-wise, a lot of the infrastructure that is getting built out in the emerging economies is, again, geared towards hydrocarbon-fueled vehicles moving goods around. And you have to question whether you will get a shift that moves from that to autonomous vehicles, and that becomes part of the infrastructure build-out. Potentially in somewhere like China you might do. It's very, very difficult to see that happening in somewhere like India. Very, very difficult.
So just kind of shifting a little bit to the U.S., Tim, the aging infrastructure leaves the U.S. very vulnerable to climate shocks. You've talked about a few of them. Can you talk a little bit about how the infrastructure community has shifted over the last few years? And if you assess the exposure for companies, I mean, are the risks appropriately priced?
Yeah, let me address that. But I do want to, and I always hesitate to challenge someone who's smarter than me. So Andrew's clearly got a deeper.
I thought you were looking past.
Right. So, but I'll go back to make the panel a little more interesting, because I think this whole debate about, I think, and I think Robert and I are on the other side of the equation where I think we need to do something about carbon.
Yep.
And I think you're like, it just is so big and so far out there, it's going to take too many years relative to, I think, your view, which is we don't do it now, we're in trouble.
Yep.
And I challenge that, because I think that's one of our biggest problems right now, is everyone's like, too big, right? And I just think, I speaking of relying on smarter people than myself, I rely on my brother, who's an economist. He's Paul Romer, and he has a view of the world that, his whole theory was ideas and technology can dramatically change growth curves and change outcomes. And so his view of the world is the governments need to encourage much more ideas and much more technology to solve these big problems and solve them now. A carbon tax or carbon tariffs, if you're worried about, who's going to pay it, do a carbon tariff. It seems like tariffs are okay these days. I just think we need to do something now to change the curves and to promote that innovation that humans are so capable of. And so I challenge a little bit I don't think China can be 60% coal in 50 years.
Maybe I'm coming across a little too negatively on that. I mean, the important thing is that everybody does what they can, and it is a mindset change. Yeah. But if we're serious about having the sort of no further carbon emissions neutral position, then you are not going to achieve that without dragging the emerging markets along with you. It's just not going to happen. And therefore, it's fine to talk about the big picture stuff, but you need to be realistic when you talk about the big picture stuff. That doesn't mean you don't need to do anything about it. But what it does mean is that whilst you're doing what you need to do, and I've challenged the UK government on this in the past, the UK government spent £10 billion on an offshore wind farm. Mm-hmm. Now, if you spent £10 billion on developing battery storage technology, you could argue that might get you quite a lot further than a large offshore wind farm, contributing to grid instability and a few other problems. Mm-hmm. And so it's a question of focus. And I don't disagree with you. There's a lot that needs to be done. And to be honest, the developing markets need to lead the way and to set an example. Because if they don't, then the emerging markets will not follow.
No, and I like Chris's analogy. I think we have to price this stuff. Mm-hmm. And if we price it, the market will adjust. And if you do a gradual, slowly building carbon tax, it gives this market ample time to adjust and change, but it gives them incentive to change. And this is where governments have a role. They need to, I think patents is a great example. A free market guy shouldn't like patents, but we all know you need patents for people to make the investment. There's things like that that governments can do to encourage innovation and technology, because that's going to solve the problem. Old economic theory would tell us that, commodities should be through the roof right now. Population's totally grown, consumption's gone through the roof, but commodity prices haven't gone up that much because of technology and innovation. We need that in this carbon debate, and we need to encourage it from a policy perspective.
Just to Tim's point, obviously I agree completely, and I'll say, listen, as investors, as fiduciaries, the last thing that's going to happen after the market's moved, after all the money has been made and lost, is the carbon price. That's going to be the final step, is the implementation of the carbon price. The rest of it, the game is in the implementation, or the anticipation and the guessing around the implementation of this. The last thing that will happen is the actual fact. So we have to be, as investors, we have to be way ahead of this in our thinking, not to get, frankly, buried.
Yeah. And I guess,
maybe I'll give you a little example where, on a government basis, you can actually do stuff, and it's a little bit of a cheating example because it's to do with Singapore, and Singapore is a city-state, and so it's a lot easier to manage a country that's only got 5 million people than it is to manage a country that's got 350, 360 million. But in Singapore, they decided a long time ago that they did not want to have problems with pollution from vehicle emissions. And so it is the most expensive place in the world to own a car. And it is an absolute luxury item. And public transport is extremely good. It's easy to be extremely good when you're only about 26 square kilometers, but it's the size of a US city in some respects. But the government decision wasn't to add $5 on a gallon of fuel or to sort of pay lip service to it. It was 350% tax on the value of a car new. It was, you can only keep a car for 10 years and you have to pay annually for the privilege of that, and you have to scrap it at 10 years, or you pay the privilege again. So the taxation that they raised through that was huge, and it means that you have 5 million people and 500,000 cars, but a fantastic public infrastructure system that is funded by those payments from the vehicle side.
Excellent.
I think, to answer your question,
Sorry.
governments are doing
I
things. But the subtlety is another great example. In Colorado, because of the warming, the level at which devastating fires goes is going higher. So it used to be that devastating fires couldn't be above 5,000, 6,000 feet. That's going higher and higher because of the dryness and the change in the climate. Colorado had a devastating fire. Denver Water said, wow, fire ruins my watershed. I got to do something about this. So they raised rates. So people are paying for this, they just don't know it. They raised the water rates, and they're paying private owners to thin their property to reduce the fire risk.
Okay.
Right? New York City, they're thinking about doing a $10 billion resiliency bond to make downtown New York, not flood. I mean, their problem is who's going to pay for it, right? PG&E is a very interesting example. I mean, to talk about hidden costs. Yep. PG&E, $30 billion liability. Now everyone's fighting over who's paying for it, and I don't really want to get into that. But if you look at San Diego Gas and Electric, investors should have known there was a value to San Diego Gas and Electric because they have gone to the point where they can turn off, like by house, electrical power to prevent fires. They have weather stations throughout their grid. They made a huge investment in their own resiliency. I'm not sure the market valued that relative to PG&E, but looking in hindsight, I'd much rather own San Diego Gas and Electric than PG&E. And so we got to get this information out there. I think governments are doing other things. They're challenged though, right? There are a lot of priorities for a government. Services, pensions, other needs that are more social related. And so the challenge is you need to find ways to pay for this infrastructure. And there are going to be more special revenues, more value-added captures, a lot of better ways to think about cost avoidance and who's paying for what. We, as an investor, we think this is great. We think there's going to be a lot of interesting opportunities in the U.S. to invest in small mid-market infrastructure that is unique and differentiated, resilient, has all the things we want as a credit investor. But I think we got to take that beyond just the U.S. Right? I think technology is a great play. Governments don't like technology. The one place where I know governments love to give stuff to the private sector, you hear a lot of debate, public-private partnerships. Should we do them? Shouldn't we do them? Are they good? Are they bad? Whenever you introduce technology, the government's like, all in. Here, private sector, do it. Technology, smart infrastructure, those are all the investments of the future. So I think there's fascinating ways, and the private sector is going to think about the climate risk. What is the climate shock? And how do we mitigate that? Because they kind of own the risk at that time.
Well, that's a great transition because one of the other topics we want to talk about was kind of the future of work. And the world of work is undergoing a period of dramatic change. The World Economic Forum has developed 8 potential scenarios on what the future will look like by 2030. And so the scenarios focus on 3 core variables: the rate of technological change and the impact on business models, the evolution of learning among current and future workforce, and the magnitude of talent mobility across geographies. And so, with that kind of a backdrop in terms of technology, the world of work, Robert, you talked a little bit about before, if technologies are creating a new form of growth and strong institutions are necessary for countries to participate in this growth, what advice would you give on this issue?
So I think the question is a really important one. And the way we see it is this. Back in the 90s with the rollout of the internet, global communities, global real-time communication, global production cycle build-outs and production chain build-outs, that was a key driver of growth for the emerging world. Today, we have big data combined with artificial intelligence. We're going to have 100 times more computational power in 10 years than we have today. It sounds smart, but I don't know what it means. I don't know if anybody really knows what it means. But I think what we can predict is that at every level of the workflow, from mundane and repeatable tasks all the way up to highly creative and highly intuitive tasks, this is being changed by the interaction of artificial intelligence and big data. Combined, we have new areas of growth in molecular sciences, in life sciences, the manipulation of molecules to create new possibilities for growth. We have robotics. We have 3D printing. I think there was an article out where Israeli scientists use stem cells to 3D print a human heart a couple weeks ago. All of this stuff is just amazing, but it all requires hugely powerful institutional frameworks. And so the bottom rung of that growth ladder is getting higher and higher and higher. And what I'm going to say is this, that first class education from primary all the way up to universities, essential. Rule of law, essential. Regulatory certainty, essential. Access to capital markets without huge risk premiums, essential. All of these things, infrastructure, availability of quality infrastructure, essential. All of these things are not easy to create just like this. And ultimately it comes down to what societies demand of the governments. And so at least what we see in the emerging world is these choices are being confronted, electorates are confronting these choices in the emerging world. And it's usually against the backdrop of poor growth. Places like Turkey, places like South Africa, they've chosen the same old crew. The choice today is the same old crew where institutions are failing, or being a modern industrialized economy. But you can't have both. And then there are some countries where you've kind of crossed a watershed. You've crossed the Rubicon in certain institutional capacity. For example, in Brazil, the rule of law and Lava Jato, that was a huge thing. And today, in Argentina, we have an absolutely seminal election coming up in October. So it's really that failure to generate growth is leading leading societies to ask questions about the frame of government, the form of government, and the types of institutions and institutionalities that supports. And some are choosing well, some are choosing poorly, but the outcomes are hugely different. That's what I'd say.
Well, continuing, one of the other issues around the future of work is really kind of the changes in demographics. And you'll see that there's expanding youth populations in some part of the world and aging populations in others, and it's really placing pressure on the workforce. For example, the Chinese middle class has expanded enormously in recent years from just 4% of the population in 2000 is expected to reach 75% by 2022. And so similar trends are also becoming evident in India and other Southeast Asian economies. So Chris, what are the risks and opportunities in this demographic shift in the global economy? And do you see private investment opportunities that focus on these trends?
I do see private opportunities. I think part of the challenge, urbanization, which we know, the densification of cities in places like China. And the demographics, when you look at Greece, you look at Italy, you look at Japan, has to factor into your investment process. People challenge us all the time because we have to earn usually on average 7% over a 30-year period. And they look at the USA and the maturity of our economy, Great Britain, France, Germany, and challenge us, where are you going to see the growth? And my point is, we're going to see that kind of 7 to 8 to 9% growth out of the emerging markets, but it comes with so many dynamic challenges. All those issues with workforce, the environment, the governance, the social pressure. So I think there are those opportunities, and I see private and public opportunities to invest in the demographic shifts. To us, it's definitely a mega trend that, I'm from California, we're the California Fund. I think in terms of surfing, we're a big fund, so I've got a long surfboard. I need big waves that'll hold for a while. And demographics is destiny, and so that's the kind of wave we can ride as a subtle theme throughout our portfolio. But there are so many risks within that I worry about. When you talk about urbanization, pollution, food, what is the future of food? What's the future of water supply? Because all that's going to get back into the environment. Not to loop you back in, but it is all very interconnected, and it's incredibly complex.
Absolutely, absolutely. In terms of, unfortunately, Jean, who is the CEO of the Global Fund for the to End Modern Slavery, could not join us. And her firm, among others, are dealing with such an important topic. Modern slavery is a crime of, generates over $150 billion in profits each year for the traffickers. And according to global estimates, there's actually 40 million people that are in slavery and over 15 million that are in forced marriages. And so in November of 2018, the Parliament of Australia passed the Modern Slavery Bill. And what it does is, and anticipated effective date is January 1st, 2019. Now the new law will require entities with a turnover of $100 million of Aussie dollars or more to publish annual statements outlining their exposure to slavery and what they're doing to address that risk. And so, Andrew, are we on the right path with more data and reporting from companies on their operations and supply chains and the actions to address those risks? And also, if you can add, how can the financial sector engage to detect and disrupt the financial flows associated with modern slavery?
Well, that's an easy question to ask a credit analyst, isn't it? I'll have a go at tackling the limited bit I can from my experience in technology. I mean, the key point, I guess, is data, and its consistency and transparency of data. And there are all sorts of ways in which that can be improved, and stuff like you've described in Australia is a very good start. I mean, there's some interesting applications that you could use for things like public blockchain disclosures by companies in this area, where if you're putting disclosure around this type of thing into public blockchain, then essentially you've got a permanent public record of what you've said about this. And it becomes very, very difficult for companies then to turn around and say, well, actually, no, we didn't say that, or, oh, I misspoke. But I think in terms of a path and a journey, you're kind of at the gate, having opened the door. What can the financial sector do? I think in terms of trying to detect this type of thing, it's really difficult. It's the equivalent of sort of fraudulent behavior and that type of activity. But if there is more demand for transparent data disclosure, then actually the financial community can play a big part in saying, well, actually, I'm not going to invest in you if you don't disclose this, and I want full and proper disclosure on it. And so I think there's an opportunity there. I think we're probably still at relatively early stages in that, but there's certainly a lot of momentum building for more sort of action and lobbying, I think, on behalf of financial investors, particularly bond investors. I think that there's quite a momentum now for bond investors to get more involved in engagement with entities.
Well, we worry about, particularly a bond investor, it's the long-term nature of the holding. And as equity investors, we're going to hold for typically 30, 40, 50 years, so we're long-term as well. It's that reputational risk to a company that we worry about, that something in their supply chain could absolutely destroy their brand image. We've seen the power of social media, and when citizens get awoken to a problem, it really affects a company immediately. So I think it's a matter of investors, bondholders, and equity asking management those tough questions. Are you drilling all the way down in your supply chain to ensure this? Because you don't want to be linked to slavery. There's no question about it.
No, absolutely. And I think, as a CIO, that having access to the data, having the exposure will at least allow us to make good decisions on whether or not we want to invest within those companies. I think that return is something that is, of course, paramount for everyone, but we want to make sure that in that we're not exposing harm through something like modern slavery. So I think that one of our call to actions is really to make sure that we do a little bit more in terms of data, for that. And so I just wanted to make sure we covered that topic. We hope that Jean is doing well, but it's such an important topic. And in doing the research, I didn't realize just how many people are affected by this and what we as the financial sector can do to actually implement change. And so I did have one other topic that I wanted to cover, and that is something that is prime topic within Milken. It's really on diversity and focusing on gender equality and what we can do. There's several different sessions that are around that. And one of the things that's really important is the increase of diverse populations and the importance of diversity in thought and teams. That's something that everyone has something that's kind of a given and confirmed. We see initiatives across several industries, you see that here at the conference, to have an increase in diverse-owned firms, have an increase in diversity within teams and in corporations. And so, Chris, I just wanted to give your thoughts. You've done some great work around implementing different programs like Beyond Talk, which is really trying to get beyond the talk and how do we get actions around diversity. So if you could talk a little bit about, in your opinion, what is the state of diversity? And please talk about the initiative of Beyond Talk, and then how do we move beyond talk?
Yeah, it actually was born out of, Beyond Talk was born out of the Milken Conference. I've been coming for quite a few years and have been participating in a panel on getting more women on corporate boards. And it was the third year in a row that I was on the panel where I said, I'm sick of this. We have to move beyond talk. We tried to do something at least that we could do, which was team up with an investment manager and really go after our industry, which is the investment management industry, and talk about gender bias, talk about unintended bias in the language we use, how we evaluate people. Right now in our country, half of the undergraduates each year are women, more than half in many cases. And that's about the average entry level in most corporations. But then there's not clean meritocracy all the way up, so that you end up with this huge skew at the top of a company where sadly they all look like me, male, pale, and stale. And we have to change that. Because as an investor, I'm all about diversity of thought. That leads to better decision making. And it doesn't help if everybody in the room all went to the same school, all grew up in the East Coast, went to an Ivy League school together. That's frankly how we got Lehman Brothers, is they looked and said, no, 42 times leverage, I'm sure that's going to be fine. Let's go to 50. So we've tried to move beyond talk I'm very passionate about gender diversity. We cover the California public school teachers in our state. 72% of our membership is female. And they absolutely get it in terms of opportunity, diversity of thought, but also diversity of color. And what I've realized, we've been working on diversity since 2003 as a fund. And boy, what I've realized is we have to change the definition. Because we think in terms of gender and ethnicity, but particularly in California, it's really more about self-identity, because it's diversity and inclusion. And inclusion means understanding that person from where they're at. So I'm trying to push my staff and our managers, should we get away from labeling boxes and labeling people to more general descriptions that people can describe themselves? The initial pushback I got was a tidal wave of opposition, because without boxes, how do I measure it? Right. It's like a big data dump. But I think that's part of the challenge is we have to measure it, we have to, define it, so we can then measure it and be intentional about it, which is the language we use, the way we recruit, retain, promote people. The data is out there, and that's why we've been very proactive of trying to educate people so that we're all self-aware of the decisions we make. And I think we frankly have to be more intentional in our inclusion of bringing people into the discussion to enrich the discussion. It's something like back to the beginning, climate change is a classic example. It's not an American problem, it's not just a Canadian or a UK problem, it's a global problem, and we need global solutions. We need a broad discussion.
No, you make a very good point. I guess on two things. One of the things that my board did was they actually put it in their investment policy statement for a target of up to 15%. And so that gave staff and the investment consultant kind of the room to go ahead and start moving toward and hiring a lot more firms. In terms of the climate change discussion that we were just talking about, I think that's what's really important is someone said this earlier in a discussion, which was, we know when we've arrived when there's no need for an ESG director or manager, when it is part of the investment process, is part of how we think about stocks, bonds, assets. It's really ingrained into everything that we do. That's when we've arrived. We just have a few minutes. I know there's a couple of people that are very steeped in kind of the ESG and diversity. Do we have any questions from the floor? Yes, sir. Is there a mic? She's
one runner, so raise your hand for a while.
Thanks. Great conversation. Lots of topics covered. One that you didn't touch on except implicitly, and that is geopolitical risk. I'm wondering how the panel thinks about that. Can you measure it? Should we think about hedging it? And if so, how?
So you said geopolitical risk. There's a problem in politics?
Sorry. Thought you'd say that, Chris.
I know. I'm sorry about that. I think a lot of people always say that's one of the things that keeps me up at night. It is really tried to, because it does link back to what we talked about, which is climate change, demographic shift, trying to understand how countries, instead of thinking more globally, are now thinking more protectionist and more local, and unfortunately thinking more shorter term. It's an externality that I think we have to price in, and all we can do is assume it's more variability and an added risk. But it's very difficult when you do an infrastructure investment. You want to count on rule of law, you're there. When you do a private equity investment, you want to be there for 10 years. And yet you may have an election that radically changes the government's perception of either your particular transaction or that industry. It really adds a lot of uncertainty and risk to the portfolio.
I mean, when you start looking at the impact of those types of risks as well, one of the things that's come out of the ESG data we started producing from January this year is that actually where you have more populist politics and where you have more highly aware populations about risk factors, you get more social issues and more social risk factors coming into play. So developed market Europe, from a credit risk perspective, looks very different to the rest of the world, where companies, non-financial corporates in developed Europe, have more impact on their credit profiles from social risk aspects to do with demographic preferences, changes in consumer preferences, changes in regulations and laws than they do from governance or environmental factors. And so you can end up having a very big impact from that. On the geopolitical side, I think one of the questions that gets missed on all of this when people say, well, what do you think about geopolitics? Actually, if politicians are serious about going to this zero carbon emission level, then you really have to question what's going to drive geopolitics, because for, again, coming up for 75, 100 years, geopolitics has all been about acquiring hydrocarbons and protecting hydrocarbons, or being in groups of people protecting a certain hydrocarbon production. And if that doesn't matter anymore, then what replaces that?
Interesting. Any other response? You have, yes, sir. One more question.
Actually, that was a great segue between that question and what you just said to what I wanted to ask you. There's been recently something that Trump gave to the DOL in terms of really focusing on the return assumptions, and a lot of folks are concerned it's going to really trample down potential investment, alternative energy, and other ESG type mandates within a lot of plans. How are you addressing that, and do you think that is an overblown issue or an issue that actually is going to get larger?
And your question is specific on the return assumption or just the way?
But focus, right? So is the government going to use focusing on return as a way to trample down ESG?
Oh, instead of focusing in on ESG
Exactly.
issues. Yeah, I think we're not an ERISA plan, so I think we've always at least hummed the tune and listened to it. We have not let short-term political shifts, particularly in the Department of Labor, change the way we look from a fiduciary, because we think in 30-year time periods, then we do care about how those issues are going to impact. And any investment you make is you make some assumption about the future. So the fact that they're telling people, and unfortunately I fear the Midwest, the middle of our country, will use that as an opportunity to say, aha, we don't have to consider ESG factors. And I would say that's the equivalent of saying all I care about is a 1-week time period. You have 30-year liabilities. As Hiro Mizuno said from Japan, GPIF, it doesn't do you any good to hand a retiree a check 30 years from now if the earth is scorched. Right. You have to think longer term, in perpetuity, investing that way and factoring those considerations. So unfortunately, Department of Labor, I could argue extensively about when they stopped them from the fiduciary law for retail investors. So it's going to ebb and flow, but I think the focus is going to continue to be on looking into that future, looking at the consequence of stronger weather. I've often said Jim Cantori of the Weather Channel is going to have to stop saying it's another historic storm. They're all going to be historic after this. I mean, the word, cyclone bomb was not in our vocabulary even 2 years ago. And now, yet they have to worry about it constantly in the Midwest.
Well, as my closing question, the objective of the Milken Conference is to generate innovative ideas, foster meaningful dialogue, and execute initiatives for the betterment of society. So we have covered key topics from climate change, diversity, technology, forced labor, and the future of work. And so to ask my panelists is, in 30 seconds or less, what is your call to action that you would like to say for your time? Start with Andrew.
So I'll give you two things. One is a broader and more general one, and that is more consistent and transparent disclosure of data. I think we've discussed that pretty extensively here. And one for you guys in the audience, if you haven't done it yet, Harvard University has a really good unconscious bias questionnaire. You should spend 10 to 15 minutes of your time doing that. They're gathering a lot of data. You'll find it very enlightening if you take 10 to 15 minutes of your time. Google it, go on, do it. It'll tell you whether you have unconscious bias in your diversity and inclusion views.
Excellent.
I said earlier, I always kind of rely on people smarter than myself. And so my father, who not only was a participant in CalSTRS, because he was superintendent at LA Unified, he was actually governor of Colorado, and he was a pilot. And he said the first thing you learn as a pilot is you never have the mental thought of, oh, don't worry, it will be okay. And he said, if you ever have that thought, you're in trouble. and you need to have a plan B. And I think this whole debate around carbon and the climate, you just can't have that attitude. It's not going to be okay. And so we need to do some things. And so my takeaway is this concept of radical transparency. I think we're all very smart. I think the world is very smart, even all across the world. If people know that someone is a bad actor doing things, I think we can force change. And so I'm a big believer in get the information out, let the markets, the free markets, decide, make choices. Governments have a role in that. They need to help encourage that or promote that. But radical transparency can change things dramatically, and we got to really get the information out. So us as consumers, investors, companies can make the right choice, because I think the science is given. We just have to figure out how to solve the problem.
So just very, very quickly, respect the uncertainties. Price the carbon in your portfolio for a multitude of different scenarios. Understand the climate costs and understand that they are going nonlinear. Follow the institutions and support institutional upgrade in active investing within the markets that you look.
Excellent. And Chris, final word?
Last one is, I'm going to ask every company we can, what are you doing to plan for a 1.5 degree temperature rise, and what are you doing to plan for a 2 degree temperature rise? And then disclose that to us as investors.
Excellent. Well, I want to thank our panelists for their time and expertise, and I want to thank the Milken Institute for having us. Thank you very much.